Let's get a quick introduction from Benny. Benny Options, welcome.
Thanks for the intro. Thanks for having me here. This is Benny Options, also known as Scott Smiley. I'm the co-founder of HiYield, and we're building a real-world asset aggregator on Avalanche, trying to aggregate all the top offerings in the real-world asset space under one roof for maximum investor convenience and access to pre-vetted offerings. And looking forward to talking to you guys here. Thanks for having me.
Great to have you today.
So real-world asset and lending. Whether you're touching specifically lending or more on the side of real-world asset, the combination of those two, I would say, primitives coming together sounds really exciting. So can you just kind of give us the context of real-world asset-backed lending? What is it and how does it work?
In terms of how things work from start to finish, I would say like you take the asset, let's go with T-bills because that's treasury bills, U.S. government bonds. That's kind of the hottest topic right now. You know, trusted off-chain entity will purchase the T-bills and put them into what's called a SPV, a special purpose vehicle. Okay, and that's like typically operated by a third-party custodian that's regulated and trusted like solely to keep an eye on those assets. And then the SPV itself will issue a token that either represents equity or debt in the SPV, and those tokens will be more easily transferable on-chain, and people can purchase them on-chain, and essentially they have the right to the proceeds generated by the SPV. And the SPV's sole purpose, right, special purpose vehicle, the sole purpose is just hold those U.S. government bonds and bring in the principal and interest at maturity. And I'd say that's kind of like that architecture can be extrapolated to really any off-chain asset that you want to tokenize and bring on-chain.
Maybe give us like a quick explanation of what an SPV, and this is beyond crypto, right? This is something that's very common in TradFi. Like, what is it being used for?
My background is in traditional finance. I worked in asset-backed securities, which is, you know, very similar to kind of what we're doing here, the on-chain component. And I worked a lot with SPVs. It really is kind of just a legal structure. It's like an LLC or some type of corporation, depending on the jurisdiction and how you want to structure it from a legal perspective. But it's really, you know, just a company that is only allowed to have kind of one purpose. And the main purpose of doing this is like making what it bankruptcy remote is the terminology that's often attached to an SPV. So let's say like HiYield purchased the treasury bills and then did not set them up in an SPV, and then HiYield went bankrupt, then the treasury bills that were backing the on-chain tokens, those would be eligible to be used to pay out you know, anyone that had claims to HiYield in a bankruptcy proceeding. But since we put the treasury bills into an SPV, the ownership is technically not, you know, HiYield's legal entity. It's the SPV owns them. So if HiYield goes bankrupt, it creates a ton of legal protections for investors that, you know, they don't have to worry about our operations at all. They don't have to worry about anything else that HiYield is doing. They know that they're in an SPV and that the SPV is controlled by a third-party custodian that has no upside in HiYield, no conflicts of interest, and you know, those assets can't be taken during bankruptcy proceedings. So the key benefit of an SPV, I would say, is the bankruptcy remoteness.
Yeah, it's a great rundown of a legal structure. I guess as the space sort of evolves, that we'll see a couple of different sort of legal structures around lending in particular and real world assets as well. What we see is that there's two distinct ways how real asset can end up on chain. One is when an SPV buys the asset itself and it holds it in custody, like Benny just mentioned. So in this case, the ownership of the asset will reside with this special purpose vehicle or this LLC that has been specifically set up to hold that asset. The other way to do it is that, let's say that the asset is an apartment. Now, this SPV will not own the apartment, but it will own, let's say, rent from that apartment, in which case this apartment will be mortgaged to this SPV, and an obligation to pay rent will still hold with the existing owner of that apartment, in which case the ownership of that apartment will not pass to the SPV in case the rent is being paid on time. So that model kind of makes a lot of things possible in terms of tokenizing value of these real assets.
For the custody of those assets off chain, SPV or a special purpose vehicle is best practice? Is there an agreement there, or there's different alternatives and theories to that?
Yeah, no, absolutely. I think that's the structure of pretty much everything we're doing here.
That seems to be the case, but we don't really know whether something else will pop up. But what we do know now is that one of the biggest sort of challenges was, how do you prove that you have that asset? How do you prove that the investors that are now exposing their portfolios to that asset, how do they know that that asset is there? And this is where I think is important that the work that Chainlink is doing with their proof of reserves protocol, and they're expanding that. We're working with them closely, expanding that into real world asset space through an audit that is performed in real world on assets that are located in real world. And then Chainlink is able to provide data on the reserves that are available in real world based on the audits that are conducted, which is a massive step. It can probably be called a solution to the problem of real world assets onboarded.
And then my question, to move on to another topic, is what's the potential of real world asset backed lending? Like, what are we going to see in the next couple of years? Is it going to be bonds coming off chain and people able to lend against it? Obviously, we hear from lenders going to be commodities, but what do you see the space looking like in the next 6 to 12 months?
I feel like that question coincides a lot with what we've been discussing here, and the inherent risk of having the custodian risk, the management of the SPV risk, like fraud risk and things like that. I do think like we're taking this process in steps. First we have like an off-chain bond, for example, like treasury bond or an asset-backed security that's held on an SPV, and then we issue a token, and everything outside of the token issuance on chain is still handled off chain. And I think we're kind of taking step by step over time here to get closer to the end borrower making repayment, and having that just flow, that aspect of it go completely on chain. And I think components of that would be pretty much easier in like a fixed income kind of bond market, where just the entire repayment of the bond and initial loan provided to the bond issuer is all handled on chain using USDC, and then you get a ton of transparency there, and the actual intrinsic value, as Donan was talking to previously, ends up on chain there. I do think that's kind of difficult when we're talking about a watch or a pair of sneakers or farmland. We can't bring the actual farmland on chain, but we can do that with fixed income assets that are all just loans when it comes down to it.
So you see it as a low-hanging fruit.
The primary reason of seeking on-chain capital would be adverse selection. I think we need to offer like tangible benefits to both the issuer side and the demand side. And there are tangible benefits that are growing. So to say that like adverse selection is the primary reason, I would want to push back on that a bit. For one, in a lot of these emerging markets, especially like the Goldfinch deal you talked about, I mean, I'm sure there's specific issues with that specific deal, but just from the research I've done in emerging markets, like a lot of the financial infrastructure is just not prepared to lend against certain types of assets, like specifically invoices. And we can take lending practices that have been, tried and tested in developed countries and much more easily apply them in developing and emerging markets, such as like invoice financing is one that I think of specifically. Through my research, I saw that Vietnam banks in Vietnam don't lend against invoices. They don't count it as collateral. They don't count it as legitimate collateral. They focus more on things like land and real estate. And just because a Vietnamese bank doesn't think that an invoice from one of their factory owners shouldn't be quality collateral, other countries and other lenders have the means and analytics in place and processes in place to lend against those. So that's a key reason that it would come to on-chain capital to more efficiently handle those types of deals. And then on top of that, like just from having worked on multiple securitizations in the past, in my traditional finance days, I mean, they're by no means efficient. And to say that like they can't do it better, I mean, like the ABS issuance process probably hasn't been reformed or improved since the 1980s. I mean, when I would work, every single issuer has their own format for loan data. There's like 20 different parties going over this Excel spreadsheet, like some macro-enabled Excel spreadsheet that's been built and being used for the last 10 years. Bringing more and more components of this on-chain. Like, what does everybody want? People want cheaper money, right? If we can lower the cost of a securitization deal by 1% by bringing more components on-chain, that's a tangible reason to go to on-chain capital and bring the securitization process on-chain, not just to offload your shitty loans.